The two-year Treasury yield led the rise in interest rates, and Federal Reserve Brad said the first rate hike could come as soon as possible. The two-year Treasury yield led an advance in rates on Thursday after Federal Reserve Bank of St. Louis President Jim Bullard said the first hike could come as soon as March. The move extended the rise that followed the release of minutes from the Federal Reserve's December meeting, which showed policymakers discussed more aggressive rate increases and the possibility of shrinking the central bank's nearly $9 trillion balance sheet. What are yields doing? The two-year Treasury yield TMUBMUSD02Y 0.885% rose to 0.886%, up from 0.828% Wednesday afternoon. Wednesday's level was the highest for the two-year rate since the 28th of February 2020. The yield on the 10-year Treasury note BX MUBMUSD10Y rose to 1.726%. Up from 1.703% at 3 p.m. Eastern on Wednesday. Through Wednesday, the yield has risen 20.7 basis points to begin 2022. Yields and debt prices move opposite each other. The 30-year Treasury bond MUBMUSD30Y 2.093% was up at 2.092%. Compared with 2.086% late Wednesday. What's driving the market? On Thursday, Bullard said Omicron variant cases are expected to subside in the weeks ahead. The first rate hike could come as soon as March, and a balance sheet runoff is one of possible next steps for monetary policy. Bullard is a 2022 voting member of the rate-setting Federal Open Market Committee. The sell-off in Treasuries continued after Wednesday's release of the minutes from the December 14 to 15 meeting, which showed policymakers felt it might be necessary to increase the federal funds rate sooner or at a faster pace than participants had earlier anticipated. The summary also showed that Fed officials had a wide-ranging discussion of how to move away from its current easy stance by hiking rates and shrinking its balance sheet. Read, Fed minutes paint a picture of a central bank ready to swiftly abandon its easy policy stance. Data released early in the session showed that weekly jobless claims edged up to 207,000 but clung near a 52-week low, while the trade deficit widened sharply to $80.2 billion in November from a revised $67.2 billion in the prior month as imports surged. Meanwhile, U.S. factory orders showed continued strength in November, with orders for U.S. manufactured goods rising 1.6%. That's the 18th gain in the last 19 months. Separately, the Institute for Supply Management's reading on activity in the services sector dropped to 62% last month from a record 69.1% in November. Readings above 50% signal expansion, and numbers above 60% are considered exceptional. Friday's December jobs report looms for traders. Economists surveyed by the Wall Street Journal look for nonfarm payrolls to show a rise of 422,000, with the unemployment rate falling to 4.1% from 4.2%. Economists say risks to the jobs reading are skewed to the upside after a much stronger than expected reading Wednesday on December private sector jobs from ADP. What are analysts saying? With the minutes out of the way and 10-year yields topping 1.70%, attention will shift to Friday's employment report. Despite a stretched technical profile, our bearishness remains intact. After all, this move is much more fundamental, Fed, and positionally driven than it is tactical, wrote strategists Ian Lingen and Ben Jeffrey at BMO Capital Markets. As a result, 1.75% in 10S is vulnerable in the near term, as is the 1.77% cycle peak. The former could give way before payrolls, but for fresh cycle highs in 10S, the market will most likely require the impetus of a strong read from the labor market and / or yet another solid inflation read via Wednesday's CPI release.